But in reality, is this actually all true? What are smart money concepts? Do they actually work? Smart money concepts have been talked about a lot more in the trading community overall, or at least I hear about it a lot more. It's gaining a lot of traction. But what are they? Smart money concepts are based on the strategies that central banks, institutions, and market makers use in order to trade the markets. Retail traders that use smart money concepts, they try to be in line with what those market makers and institutions and central banks are trying to do. They want to be on the right side of the market. Let's think about it a little bit. Us retail traders only account for around 5.5% of the Forex market. And every day there's around a volume of $6.6 trillion being traded in the market. And what this means is that we are playing with the big boys. So why not try to play like the big boys?
It'd be a lot cooler if you did.
So in this video, I'm going to talk about three concepts, which is liquidity, order blocks, and market inefficiency. I hope me explaining this can give you a little bit of a newer perspective in the market. It's not supposed for you to be building a strategy out of this video because we are not going to talk about strategies. We are going to talk about concepts. But this might spark your interest into learning how you can possibly trade these concepts. So let's start off with explaining how liquidity works. Has your stop loss ever been hit and then the price moving in your direction? Oh man, I wish it didn't happen to me. Or have you ever seen a large wick followed by a very impulsive candle? Well, this is a lot based on liquidity because if you are short, your stop loss means that you are going to protect your sell by buying the position back, which means that you are selling your position to someone. Well done. I just made it seem more complicated than it actually is. But what this means is that your entries, your stop losses, your management, all of that is going to be giving liquidity to the market by either buying or selling. If you are entering in the position, you are buying or selling, and exiting a position, you are going to do the opposite of what you did previously. If you are trading 100k, 200k, maybe even a million, the market doesn't have a big problem in setting our trades because, as we said above, we are just small fish. But think of institutions. They are not trading millions or thousands. They are trading billions. So they do not face the same problems as we do. They face demand issues where they can't fill their orders completely at their desired price. And that's why they need to play with this liquidity. Let's say that the price is at $1.2. Well, they can't just put a market order just like we do because it wouldn't be completely filled. But let's say that there is a lot of people wanting to buy at $1.22, meaning that there is a lot of demand there. Maybe a lot of stop losses or simply buying sentiment. This means that a big chunk of their position will be able to be filled at 1.22 because that's when supply meets demand. So what they do is that they push their price from 120 until 122 by making buying orders, reaching the point where there is liquidity, again where supply meets demand, and they can indeed fill their orders. And then just let the market play out and let the market go in their desired direction. They can see these levels of supply and demand by looking at the order book, which you've probably seen something like this, but theirs is probably a lot more advanced. So yeah, this is how they make their orders be completely filled. This is how they play with liquidity. This is how they play with supply and demand. And this is something that you actually can see on the charts where the price doesn't just tank in one direction. It can happen, obviously, but when the price tanks, you normally see the price trickling back a little bit slowly, and then keep going. So this is basically a simple explanation of what liquidity is. So now let's move on to order blocks. An order block is an area on the chart where you can see that a large order has been placed. You can see this by a large move from that particular area. And the so-called order block is the candle before that large move. And this becomes an area of interest of people that trade smart money concepts. They expected price to trickle up into or down into that order block and then fill the rest of the positions and the liquidity that remains there and then keep moving in that direction. These can also be areas of supply and demand where you see that a large institution has put a large order from that order block, and you know that, as we've talked about, they want to fill the rest of their position. And if that's their desired price, then they are going to make sure that the price gravitates back onto the rest of their order block, fill in with the rest of the liquidity, and then moves in the desired direction. These can be used for entry points and for stop loss purposes. And if you choose the right ones, be it in whatever time frame you are on, you can get very precise entries. But again, it comes with a lot of hard work into understanding what are the right ones and what are the wrong ones, which ones work and which ones don't work, or at least in probabilities, because in trading, we always talk about probabilities. Because if you look at the chart, you can kind of see order blocks or smaller candles filled by larger candles everywhere. You just need to understand which ones are the right ones. But now let's talk about market inefficiency. Efficient price action is when the high or the low meet with the high or the low from the next candle, as shown here. Efficient price means that both buyers and sellers had enough time and liquidity to fill their positions. Everyone had access to the liquidity to fuel the move. But when we have rapid movement in the market and we have big candles, it leaves an imbalance. Let's say that there is a big bullish candle. This means that a lot of people were buying, and there wasn't an opportunity for everyone to fill their trades, which means that for everyone to be satisfied, the market will have to trickle back, fill that imbalance, give everyone the opportunity, and then move in the desired direction. Now, people don't really trade this actively, but it serves as a confluence into order blocks, because if you have an order block below a lot of market inefficiency, then you know that it first has to fill all of that in order to buyers and sellers to be happy with their positions. Then it taps the order block, which, as we've seen, is a lot of orders in that particular price, and then the price is able to move up because there will be a lot of demand for that price yet again, meaning that the price is going to increase. But in reality, is this actually all true? I think these are really three important smart money concepts that everybody should know. A lot of people question if these concepts are true and if they actually apply in the market. This general sentiment comes from, in my opinion, two different types of people, which is one, people that never looked at smart money concepts, and two, people that tried it and didn't make it work for them. Because it is true. It simply makes sense. That's how the market moves. How do you think that there is a $6.6 trillion volume without being any strategies made by institutions? You just need a little bit of market knowledge and financial knowledge in order to see that these are actually true. Institutions can't simply just make a market order of like 2 million lots. It's not going to happen. There is not enough demand. But the thing is, it's not easy to trade these concepts and make them work for you. It takes a lot of testing and I think also prior market knowledge and prior market experience. But if you are able to read the market using these concepts, you can get very, very precise entries and huge risk rewards. I can tell you right now that I don't actively trade smart money concepts. They are in the back of my mind, but they are not implemented in my trading plan. What I can use them for is as confluence for my trading. I recommend trading smart money concepts for people that have been years in the market and want to expand their knowledge. But for people that are newer in a market, I really wouldn't recommend smart money concepts because it's quite an advanced strategy or way of trading and it requires a lot of work. It kind of requires a lot of workflow and being able to backtest and understanding the backtesting data, and that is something that comes with time. So I would say, in my opinion, you can disagree with me on this, perfectly fine. I think that newer traders should stick to something less complicated. If you guys want to see the biggest reason why traders fail, I think this is a very important video. It's going to be this video right here, and I hope you enjoy. I hope you enjoyed this video. I hope this could clear your mind in any way, shape, or form, and I hope this helps. And I will see you next week. Peace.